Today, I'm going to do something a little bit different, and that is I have received hundreds of questions and comments on my YouTube channel over the year, and I'm actually going to give you real questions with real answers today. So these questions stemmed around a second home investment property video that I did. So let's start with the first one. My primary home is mortgage-free, and I plan on building a second house in another state prior to retiring. My plan is to retire in 2 years, then move to that second house and use my equity to pay it off. What loan would you recommend for the second home? I plan on building the home myself and I already own the land. Okay, our response was, we asked him just to call the office because there is a lot of complexity in this type of question. And sometimes we just can't get it all out. We just need to connect, ask more questions, and then be able to discuss strategy. We had somebody chime in though, and I love this because Sticky Bandit chimed in and said, meaning you don't have an answer because no loans let you do this. And that's not the case. So I wanted to set the story straight that there are different strategies. But it is important to know that rarely in home lending is it a one-size-fits-all answer. So much of the detail that goes into the qualifications, whether that's cash reserves, whether that's income, debt-to-income ratio, etc. And on this particular situation, because he says, I plan on building the home myself, the initial question would be, are you a licensed general contractor? Because if you're not, and that's not your business, it may be difficult to obtain a construction loan. So there are 3 strategies that I would have spoken with this client about had he called. And that is, 1, a construction loan may be an option, but we would definitely need to dive into when he says he's going to build it himself. What experience does he have? Again, is he a licensed general contractor? Because the construction loans have very stringent guidelines around licensed general contractors. The next option is, depending on how much equity he has in his primary home, he could consider putting a home equity line of credit on his primary home and then just drawing from that line of credit to build the new second home. So that could be strategy number 2. And then strategy number 3, and you can see why having a discussion would be important, is how much does he have in assets? So if he has a very large stock account, let's say, there's another strategy that he could potentially put a margin account on his asset, on his security asset, and then draw from that. It very much works like a home equity line of credit, but not being tied to his primary residence, is actually tied or leaned against his assets. So there's a variety of ways that if he's not a licensed contractor and a construction loan would not necessarily be the conduit or the right strategy for him, it doesn't mean that loans don't exist. It just means that we have to think bigger and really know more of the story to kind of dive into the strategy. So hopefully that helps answer the question to Sticky Bandit and our initial person that asked the question. Next question. I plan on using my current home as a rental unit. I still have a mortgage. I will profit $500 to $700. The next home I get will be my primary residence. Can you please help me understand how that transition will work? Okay, lots of moving pieces here. First of all, awesome. You're building wealth through real estate and you purchased your initial home. Sounds like it's a primary residence. You've probably been in it for a couple of years. Now you're going to retain that residence. You're going to rent it out and you're going to go buy a new primary. So that is the way it's done. Secondly, when we dive into answering this question, the answer is really going to be predicated on the type of loan that you're going to use on the new primary residence. So for example, if you're going to use a conventional loan, then you would need to do the following. 1, keep in mind that on a conventional loan, if you don't have any rental history, so you have not ever been a landlord, you haven't owned any property that you've rented out, then the conventional lending guidelines are going to only count 75% of the lease agreement, and you would have to have an average rent schedule to support that lease agreement. So let's kind of walk through it. Let's say that the lease that you receive is $2,000 a month. 75% of that is $1,500. But let's say that your total house payment, principal and interest, taxes and insurance, the whole kit and caboodle, is only $1,300 a month. then you don't get that extra $200 that counts as income into your debt to income ratio on the new loan. That's the point here. Unless, of course, you have rental history. I'm sharing this because there's a lot of confusion and there's a lot of stuff out there on social media that says, yeah, the lender's going to take 75% of the lease agreement and it's going to help you qualify. Well, it's only going to help you qualify without rental history by offsetting your payment, assuming that the numbers work. So hopefully that helps. Now, if the new loan is going to be FHA, then FHA has a whole different set of guidelines. FHA says that first and foremost, the new house has to be 100 miles away from your departing residence. So if that's not the case, then FHA is likely not an option for you with the new primary residence purchase. Secondly, let's assume it is. Let's say you're relocating, you're moving to another state. Now you meet that 100-mile distance. FHA is only going to use 75% of the rental lease agreement to offset your payment. So again, there's no option on FHA to count any difference, even if you had rental history in the past. So hopefully that helps you kind of like understand. I love where you're going. I love the fact that you've done the math. You know that you're going to cash flow, and that is still a reality. It sounds like you still will cash flow based on the numbers you've ran, but from a lending standpoint, how the lending guidelines are going to utilize that rental income is going to vary. All right, next question. We just bought our primary residence, but in 5 years, we would like to purchase a vacation home. We are both teachers and don't make a ton of money, but we want to be smart with what we have. What's the best thing we can do now to prepare to purchase another home in 5 years? All right, when we think about vacation financing on a conventional home loan, first and foremost in your head, know that you have to put a minimum of 10% down. And interest rates and costs on conventional loans for second homes will improve the more money you put down. That being said, the first thing you can do over the next 5 years is to start to set money aside to save money for the down payment. That's going to help you get the best terms and be in a position to be able to get that lowest payment, which it sounds like that's going to be important for you. Outside of that, I would say just keep debts at minimum, meaning pay off credit cards every month, be frugal with new car purchases, because credit card payments, car purchases, student loans, all of that goes into the debt to income ratio that's going to be calculated on that new second home. So hopefully that helps. The last question in this series, I'm renting my home, but I forgot to tell my mortgage company. I have been renting it since September 2024. Will I get fined? No, you're not going to get fined, assuming that you met the conditions of the deed when you either last refinanced or you purchased. So that's a piece of this question I don't know. I'm assuming that you resided in the property. If you called it a primary residence, you resided in the property for at minimum 12 months. And if that's the case and it's been a couple of years and you decided to rent it out and either go rent or buy another house, totally fine. Just let the lender know. If you're less than 12 months, this is where it gets sticky, because a lot of people don't necessarily read the loan documents or understand the intent that they're signing to. So when you take out a home loan for a primary residence, meaning that this is going to be a property that you're going to live in as your primary residence, the deed that you're signing actually says that it is your intent to occupy that property as your primary residence for 12 months. And where we get into this whole thing called occupancy fraud is when people say that they're going to do that, but then they close on the mortgage and the house gets listed for rent within, weeks or a couple of months from that acquisition, and maybe they never moved into that house, then technically that is mortgage fraud, and that's what we don't want. So I appreciate you asking the question. Hopefully that helps. Now, hey, if you like me answering these questions, please comment below. I might be using it in a future video.